That's a high order there, Bruno, but I'll do my best. Let me join my predecessors in acknowledging with thanks Judy and Matthew's invitation to be here. It's a privilege and an honor to be here and join you, ladies and gentlemen, today. I'd like to talk about a couple of things, but before I begin, I'd like to take you back 10 years ago to the point in time where the profession joined together 10 years ago at Vanderbilt University in the city of Nashville to commemorate the 35th anniversary of Black-Scholes, and it is a tribute to their model that we are here 10 years later, still in recognition of their contribution to the profession. So this is what Myron looked like 10 years ago, and Bob. Well, no, you're there too. You can't avoid this, Myron. You're there in the back next to Leo. And in fact, to show you, ladies and gentlemen, the continuity of things, the panel in which Myron contributed at the end was a panel focused on the direction of financial innovation in the next decade. And if you look at the topic of the panel this afternoon, the concluding panel, I think Myron can tell us what has changed since he spoke to us 10 years ago. So, what I'd like to talk about, ladies and gentlemen, is what I like to characterize as the message from markets. And in accordance with some of our illustrious predecessors, I'm a firm believer that market prices tell us a lot about the world. In fact, they quantify things for us. And so I think it's incumbent, in addition to the modeling of it, to understand what it is that markets are telling us. And in that regard, I'd like to talk a little bit, one more time, about VIX. And then I'd like to turn to Merton's jump diffusion model and quantify the jump risk in those markets in which I have some interest, which is the options on oil futures contracts. I'd like to conclude the model that looks at another aspect of this, and that is the issue of idiosyncratic variance. So as you know, one of the artifacts, one of the clear signs of a crisis in financial markets is when you have decreasing idiosyncratic risk relative to systematic risk. Systematic risk becomes the dominant driver. So I'd like to offer a model that addresses this and tries to elicit that from the prices of traded options. And so until Bruno tells me that it's 10 minutes, I will venture forth. So the issue of the informativeness of markets is something that dates back at least to Hayek, if not earlier. The notion that the price system is a system for communicating information. And I think those of us who enjoy looking at financial markets, one of the things we like to take out of it is that it quantifies things for us. It tells us how nervous and uncertain we are in one crisis relative to another. More frequently, I hope I'm allowed to quote from a textbook. I know it's a little unconventional. One of the quotes that I liked from the Brealey, Myers, and Allen textbook is the Reading the Entrails, which comes, I gather, from the Delphic Oracle in Greece. The notion that security prices tell us about the future, and the challenge to us in the profession is to elicit what it is that they're telling us. Then finally, of course, there's this famous quip by Paul Samuelson that the market has forecast 9 of the past 5 recessions. So, in talking about VIX, what would I like to show you? What I'd like to show you is, in particular, 2 episodes in the past. The period of, before I get to that, sorry. One of the things you can see as you go back in time, go back to 1990, you can see the various episodes of crises through which the market and the world have gone through. So you can see here different crises. I won't elaborate all of them. You see the Asian financial crisis, the recession of 2000, 2001, you can see how the market has quantified the magnitude of those crises by telling us what the implied vols were at different points in time. But the particular points in time that I would like to emphasize to you are the next 2, which are 1991 and the spring of 2003. What is common across those two episodes? Persian Gulf I and Persian Gulf II. Right, so it's particularly symbolic to talk about that in this part of the world. And I'm not a political scientist, but one of the things I find really interesting is to look at the high water mark of VIX during these two episodes. The episodes were very different in a number of ways, but in one way, they were very, very similar. And the way in which they were similar was the height of the implied volatility during Persian Gulf I. That was 36.47. And during Persian Gulf II, it was 34.69. So markets were telling us, one interpretation, that these two crises are approximately the same in terms of their magnitude. And that's one of the things that makes it particularly interesting, I think, to compare VIX across different crises as we go through the months of November and December of 2018 and compare them, say, to 2008 and the like. They quantify these things for us. They give us a way of looking at these different crises. And one thing that I'm not going to be talking about today, but I know you ladies and gentlemen are familiar with, is the notion not just of the level of VIX, but the term structure of volatility on the S&P 500. Those differ considerably across crises, and it is sort of interesting to see how they differ between a crisis period and a non-crisis period. So this is the height of VIX during the Great Recession. You know that it reached 80.86%. So that was the height there. And I think from earlier today, we know what the high water mark, the overall highest point VIX ever reached was when?
I heard 87, they reconstituted it at 150 or something.
Very good, Bruno, that's right. You know, every time I present this, I keep dating myself and that I know about the crisis of October 1987. I don't think I'm dating myself in this audience, but when I talk to my students, yes, this is the highest ever value. This is actually the predecessor to VIX. VIX didn't exist until 93, but VXO reached a level of 150%. So that's the issue of looking at VIX to tell us the significance, the acuity, the depth of the crisis in which we find ourselves. The second one I'd like to focus on is one in which I have a personal interest, and that is oil markets. And so what we'll be looking at here is the futures contract on oil. I'll be looking at the WTI. I think Bruno was talking about Brent or the other market. There are two major markets, as you know, in oil. One is the one in the WTI, delivered in Cushing, Oklahoma. Brent is the North Sea one. What's interesting here, ladies and gentlemen, is to see the correlation between oil markets and the S&P 500. And I commend in particular the time period that was between 2008 and 2013. You can see that the correlation between oil and the S&P reached very high levels. This is quite distinct from the way it was in the end of the previous century, in the earlier part of this century, when oil prices were typically uncorrelated with the S&P. They became very strongly correlated. Some people called it financialization, but you know, the term you use is occasionally indicative of what you believe is the driver. So whereas some people call it the financialization of oil markets, I call it integrated capital markets. And you can see where one is a pejorative, the other becomes a very natural thing that you would expect to see. So the correlations were very high. And if I can remind you of this period, there were good days and bad days. On bad days, the world was coming to an end. The S&P was crashing and oil prices were falling. On good days, the sun was shining and both oil prices and the S&P rose. The one exception to this period is this period over here. So what was happening in that time frame? It's the early part of 2011. No, those were crises, but not this particular one. This is sort of more of an oil-related crisis.
Price was
It wasn't, Enron was 2001. Believe me, I remember that period. No, but someone said it over here. That wasn't, this isn't 2011. $145 a barrel was 2000. Right, that was 2008, Myron. So it went from 145 to 33. But this should speak to people. Exactly, the Arab Spring. The Arab Spring was 2011, and what's interesting, I don't want to get political on you, but what's interesting was the Arab Spring was a very short time period when you look at financial markets. And I know it's gone on longer than that, and it's far more important in other aspects, but what's interesting is to look at the Arab Spring in terms of financial markets. So what financial markets were concerned with was not so much North Africa. North Africa, as you know, doesn't produce that much oil. Egypt produces oil mostly for domestic consumption. Libya produces oil on good days. Tunisia doesn't produce any oil at all. The concern was not North Africa. The concern was contagion to the Persian Gulf. And when the market saw there would not be contagion to the Persian Gulf, we went back to worrying about the economic recovery. So it's sort of interesting to see how the Arab Spring was a relatively short phenomenon when it came to financial markets. So what perspective would I like to present to you on this? The perspective I'd like to present to you on this goes back to the very well-known vol skew that we observe in both the equity and commodity markets. Now, as you ladies and gentlemen in this room know far better than me, the vol skew in equities is downward sloping. We typically are concerned with crashophobia. And so this is the vol skew in the equity markets. Essentially what I'm portraying here, as you probably know, is implied volatility by moneyness, where moneyness is on the horizontal axis and depicted in the ratio of the strike price to the underlying. So in the equity markets, it's crashophobia. In the oil markets, we have not a sneer but a smile. It's a U-shaped volatility skew because oil markets, in contrast to equity markets, can be subject to both crashes as well as spikes. Exactly.
May it be the case, though, that we all are long growth stocks. We're all long growth assets, so human capital. So there's not an actual hedge in the oil markets. It's natural hedges, and basically you could think it would be pretty symmetric on average. Occasionally get asymmetric, but you got to think about who tells us.
Right.
So I would imagine that we get a downward skew in equity markets and up to zero-ish on average when we have oil markets.
No, I don't disagree, Myron. It's what? No, agreed. But do you not agree that one rationale might be that we have observed in the past both crashes and spikes? So we've got demand-side crises, a la the Great Recession, where oil prices have fallen, as you said a moment ago. In contrast, we have geopolitical crises where oil prices spike. No, I'm talking about the skew as well. In other words, I interpret the skew, now maybe we disagree on this, Myron. I interpret the skew as sort of crashophobia. In other words, which, I shouldn't use skew? No, which language should I not use?
So nothing wrong with your interpretation. Let's say one of the explanations for the downward slope in equity indices is so-called leverage effect.
Oh, okay.
And
Yeah.
we can see how that wouldn't apply to oil. Okay,
I think what you're saying is that the market does not like changes in oil. They like it to be where it is. If it's a spike that bothers people, there's risk. And if there's a drop in oil, that bothers risk because it changes something or other. So they want the steady state.
Well, I'm not sure if I want to go quite that far. Let me say that I guess what I'm saying, I think what I'm saying, is that what we've observed in the marketplace in equity prices, regrettably, when we have large changes, they're to the downside. So option traders, if they're delta hedging, have losses when they, you don't agree with that?
I totally agree.
Oh, you totally agree. Okay. In the oil markets, we can have both crashes and spikes. In fact, again, I'll date myself, but for those of us growing up in the 70s, we were typically seeing geopolitical crises, right? If you think of the two oil price shocks in the 70s. What we've seen more recently, of course, have been some tremendous demand-side shocks, which have caused prices to decline. But
And why is that risky? What is the risk premium?
this isn't quite, I don't know if this is a risk premium. The way I would interpret it is the tracking error losses that you incur when you're delta hedging. If there is a large negative shock and you haven't been able to adjust, you've got tracking error losses in the equity markets. The way you price protect yourself on that after October 1987 is to bid up the cost of implied volatility for options that are strike prices below the money. And all I'm saying is that in the oil markets, you have both directions possibly going. Yes,
I think just very briefly, what happens
please.
when you have a smile both ways, which is called a smile,
Right.
because there's a monetary policy, it's more like a currency. So it depends on what the oil policy is. Either people think that the Arabs are going to raise the price or lower the price, whoever wants oil. In stocks, it's a permanent, we're on the market. It's a completely different thing. It's more like a currency or commodity.
Well, I don't know if we agree or disagree. What I'm saying is that I think oil markets, as they form prices both in futures and in options, take everything into account. They recognize that there's OPEC out there with or without the ability to manipulate prices. They recognize there are different shocks that can occur in the marketplace. What I want to point out to you is OPEC didn't drive these correlations over here. These were very much demand-side correlations. Prices fell because the demand for energy was declining. And then, of course, it recovered. But that's why prices fell. And what I was trying to contrast here is, of course, the existence of a geopolitical crisis within the demand-side crisis that we saw at the time.
What are the implications in terms of pricing? Say you have tracking error, which is a residual.
Right.
They're a hedger, so that's their business. They know they're going to carry most of the time, and then they get hit occasionally. And that's the business.
Right.
So basically, how does that affect the pricing of that market or call?
So I think you know this, Myron, but my sense is that until October 1987, the Black-Scholes model pretty much applied in the sense that the vol skew was all virtually flat. When markets recognize that there can be crashes in the modern era, not just in the 1920s and 30s, we developed a volatility skew that was the way by which option traders protected themselves against those large tracking error losses they would incur should there be a crash. Are you? This is in the equity market.
I would agree. I think it's basically what's happening is that we do have these, the pricing has to take account of the downside of stocks and the curve. That means there's a much greater demand for points than
What?
after prices, and that demand affects the price. And there's a natural hedging requirement that people have.
Okay.
Diminution.
I'm sorry? Diminu. Okay. Oh. That's not fair. You should give me the time that I had to defend myself, Bruno. All right, so the diminute. So here's what I took Bob Merton's jump diffusion model and calibrated to the prices of options on oil futures contracts. And essentially, the parameters that I wanted to elicit were the last three over here. The risk neutral, I'll admit these are risk neutral parameters, the risk neutral average amplitude of the jump, the variance of the jump, and the variance of the diffusion process. We couldn't quite elicit the intensity because there wasn't enough precision in the data to be able to elicit that, so we made the assumption. And so basically, this is a model that I actually had occasion to not discuss the exact model itself, but Dudi Gershon, in discussion we had at lunch 6 years ago, encouraged me to think about a model that would more carefully fit option prices. And so that's when I worked with Barry Murphy to calibrate this model. And I don't have time to show you all of it, but essentially what we did was we sought to estimate at each point in time the time to maturity dependent parameters of the average jump amplitude, the variance, and the diffusion, subject to the assumption that we could observe data that was reliable. And what I do want to show you on this is the implications that we drew when we applied this to the spring of 2011. So when you look at the spring of 2011, what we did was we standardized the jump amplitude to 30 days. So obviously there isn't exactly 30 days, so you have to interpolate between less than 30 and above 30. And the thing that I commend to you, and this goes back to our discussion of the volatility skew just a moment ago, the thing that I commend to you is the change in the average amplitude and the sign of that average amplitude jump before the onset and after the onset of the Arab Spring crisis. So most of the time, including today, perhaps surprisingly for those of us who grew up in the 60s and 70s, the K-bar is actually a negative sign. Markets are more concerned about crashes than they are about spikes. But notice what happens as the crisis begins to permeate into the Middle East. The negativity here starts being positive and becomes very strikingly positive upon the first contagion to the Persian Gulf in the countries of Bahrain and Kuwait. Then there are some concessions by the monarchs in both of those countries, and by May 3rd of that year, we go back to worrying about whether or not the economy is going to recover. So the Arab Spring, as you saw earlier in the correlation, is restricted to a relatively short period of time in terms of financial markets. Obviously, it's had far more important effects in political markets and in other areas, political issues and other areas. All right, the last thing that, under Bruno's constraint, so the issue here is, can we say something about forward-looking idiosyncratic variance? And the idea, as I think you ladies and gentlemen know very well, during times of crises, idiosyncratic variances increase relative to systematic. And the question is, can we tease some of that out of the option markets? So if you take a one-factor model, like the one that we know and love well, apply the variance operator, you get equation 2, which says that the stock's total variance is beta squared times the market variance plus this idiosyncratic risk. The left-hand side of equation 2 is not a summation, it's a capital sigma term to denote the total variance on the return on stock I. So the nice thing about equation 2 is that it applies both retrospectively as well as prospectively, and it applies to different times to maturity. Okay, so obviously with option markets, we have times to maturity going out, say, 2 years. That's what we use. And so what we wanted to do, what I sought to do, was to elicit in what way we can tell about the future from option markets. Now, I know you recognize that of this equation over here, for different times to maturity, you can observe the total implied variance on the stock and the markets. You cannot observe a forward-looking beta or a forward-looking idiosyncratic risk. So this is where the modeling comes in equation 4. I took the historical beta, which is the one with the caret, and appended to it a linear term that you see over here, an intercept plus a slope coefficient times time. In some sense, the simplest possible extension of a functional form for time to maturity. With beta, we don't observe a term structure, so that's where we need this over here. The same is true of idiosyncratic volatility. So to allow a term structure volatility in the implied vols, I embedded this kind of structure. And then the issue in terms of calibration was simply to take option prices each and every day and calculate what? Calculate the 4 coefficients alpha 1, 2, 3, and 4 as observed in option markets that day. That is relative to the historical beta and relative to the historical variance, what are option markets telling us about the intercepts and the slope with respect to forward-looking betas and sigmas? Parenthetically, very quickly, Bruno, the sum of the, how many? 12 minutes. That's what, that's 13 in French, is it? You know that the sum of the weighted average of betas is always 1. And so if you do anything like this, you're assuming that the industry that you're looking on is different from other industries. One of the things we found was that there's a negative correlation between alpha 1 and alpha 2. So if alpha 1 is strongly positive, that is, forward-looking betas are very high, they tend to decline back to their normal levels later on. Okay. I also did a two-factor model, Bruno. I figure if I speak to him personally, maybe he'll give me a little bit more time. I don't know if that's going to work. In the two-factor model, I incorporated oil prices. The thing that I want to show you here is that out of the two-factor model, you can take this intercept term that you have as well. The key thing, ladies and gentlemen, is to understand what alpha 3 is telling us. So as we enter into a financial crisis, alpha 3 is going to be what sign? If we enter into financial crisis, forward-looking idiosyncratic relative to historical is going to be lower, right? So alpha 3 is going to be negative, and as we come out, alpha 3 is going to be positive. Okay, so ditto for this two-factor model over here. I don't have time to talk about this, but I know the difference between risk-neutral volatility and objective volatility. I'm not going to do anything about the market price of volatility risk, but I want recognition that I know it exists. We looked at 8 stocks in Bloomberg's BizOilP index. BizOilP now, as Bruno actually may know, has more than 8 stocks. They've been expanded, but at the time we started it, there were 8 stocks. We removed Anadarko Petroleum Company when it was involved with the Deepwater Horizon explosion in the Gulf of Mexico, thinking that that sort of affected. Here's the bottom line. The bottom line is, as you look at markets, ladies and gentlemen, there are different indicators of how bad things are. So, for example, the Merrill Lynch Bond Index peaked on October 30th of 2008. VIX peaked on November 20th, 2008. The market bottomed out in March of 2009, and S&P implied correlations actually peaked later on. So maybe there's something wrong with those implied correlations. But the point is there are different indicators of how bad things are. And the 2 bold-faced ones are what I can tell you from the models that I've been presenting to you. The forward-looking alpha 3 declined sharply on September 12, 2008, and the first sign of recovery as alpha 3 turned positive were in February of 2009. I have here a graph of the 2. What I want to end with, this is the last page, is the correlation between these 1-factor and 2-factor shocks to idiosyncratic risk and VIX. And you'll notice for virtually all the subperiods, that correlation is negative as it ought to be, right? Because when VIX is high, alpha 3 should be low or negative. So the argument is that these shocks to idiosyncratic variance may be informative of some information that's not picked up exactly by VIX, and so it may be meritorious to look at that. So in summation, I think we should recognize, and we do recognize, the contributions of Fisher, Myron, and Bob. One among the many things that they've told us is to quantify how nervous and uncertain is the financial market at any point in time. Using Merton's jump diffusion model, we were able to elicit how changes in oil prices behaved during the spring of 2011 and displayed to us, perhaps surprisingly, that the Arab Spring of 2011 really was restricted to the spring when it came to financial markets. And finally, I hope that the model that I presented at the end, albeit in somewhat circumscribed form, is hopefully an interesting one in terms of eliciting forward-looking idiosyncratic variances. And with that, Bruno, I return it to you.